How the stock market actually works. Every day, trillions of dollars move through the stock market. Prices go up, prices go down, people make money, people lose money, and for most people, it feels confusing, almost random. But here's the truth: the stock market is not random, it follows clear rules. And once you understand those rules, everything starts to make sense. So let's break it down. What is the stock market? At its core, the stock market is a place where ownership is bought and sold. Ownership of companies. When you buy a stock, you're buying a small piece of a company. That's it. If you own a share of a company, you own a part of its future, its profits, its growth, its risks. Now imagine a company wants to grow. It needs money. It can borrow money or it can sell ownership. When it sells ownership to the public, that's called going public, an IPO, initial public offering. This is when a company lists its shares on the stock market, and anyone can buy them. From that moment, the company's value is determined by the market, not by the company itself. So, what determines stock prices? Simple answer: supply and demand. If more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. But what makes people want to buy or sell? That's where things get interesting. The first factor is expectations. The stock market is forward looking. It's not about what a company is doing today, it's about what people think it will do in the future. If investors believe a company will grow, they buy. If they think it will struggle, they sell. So prices move based on expectations, not just reality. The second factor is earnings. Companies report their profits regularly. If a company earns more than expected, the stock usually rises. If it disappoints, the stock falls. But even here, expectations matter more than numbers. A company can make money and still drop because it didn't meet expectations. The third factor is interest rates. Interest rates affect everything in the economy. When rates are low, borrowing is cheap. Investing becomes more attractive. Stocks tend to rise. When rates go up, borrowing becomes expensive. Investments become riskier. Stocks often fall. So the stock market is closely tied to central bank decisions. Another major factor is news, economic news, company news, global events. Markets react instantly. A single announcement can move billions of dollars, but here's the important part. The reaction is not always logical, because markets are driven by people, and people are emotional. Fear and greed play a huge role. When markets are rising, people feel confident. They buy more. This pushes prices even higher. When markets fall, people panic. They sell. This pushes prices even lower. This creates cycles, booms, and crashes. And this is why the market can feel unpredictable. Now let's talk about something important. Why do stocks go up over time? Because companies grow. Over the long term, economies expand. Businesses earn more. They innovate. They increase productivity. And that growth is reflected in stock prices. But not all companies succeed. Some fail, some disappear. That's why diversification matters. Instead of investing in one company, investors spread their money across many companies. This reduces risk because even if one fails, others can succeed. Another key concept is market participants. Who is actually buying and selling stocks? It's not just individuals. There are institutions, large investors, funds, banks, hedge funds. These players control huge amounts of money, and their decisions can move markets. For example, if a large fund decides to buy a stock, the price can jump quickly because of the size of the investment. Another concept is liquidity. Liquidity means how easily something can be bought or sold. Stocks are highly liquid. You can buy or sell them almost instantly. And this is one of the reasons the stock market is so active. Now let's talk about valuation. How do investors decide if a stock is expensive or cheap? They use different methods. One common method is comparing price to earnings. If a company earns a certain amount, how much are investors willing to pay for it? Higher expectations lead to higher valuations. But higher valuations also mean higher risk. Because if expectations are not met, prices can fall quickly. Another important idea is risk and return. Higher potential returns usually come with higher risk. Safe investments offer lower returns. Risky investments offer higher potential returns. The stock market sits somewhere in the middle. It offers growth, but with volatility. Now let's talk about timing. Many people try to predict the market. Buy low, sell high. Sounds simple, but in reality, it's extremely difficult. Even professionals struggle to do it consistently. Because markets react to information instantly, and new information arrives constantly. That's why many investors focus on long-term investing. Instead of trying to time the market, they stay invested and let growth happen over time. Another concept is compounding. Compounding means your returns generate more returns. Over time, this creates exponential growth. Small gains can turn into large amounts, but it requires time and consistency. Now, here's something most people don't realize. The stock market is not the economy. They are connected, but not the same. The economy reflects current conditions, jobs, production, income. The stock market reflects expectations about the future. That's why sometimes the economy can struggle while the market rises, or the opposite, and that confuses people. But once you understand the difference, it makes sense. Another key idea is that the market is a system. It connects companies, investors, and capital. It allows money to flow to businesses. It supports growth. It creates opportunities, but it also creates risk. And that's why understanding it matters. Because whether you invest or not, the stock market affects you, your retirement, your savings, the economy around you. So how does the stock market actually work? It's a system driven by supply and demand, powered by expectations, influenced by interest rates, news, and emotions, and shaped by millions of decisions every day. Once you understand that, it stops feeling random and starts feeling structured. Not easy, but understandable. If you found this video helpful, consider subscribing for more content about money, investing, and how the system really works. And let me know in the comments, do you think the stock market is predictable or unpredictable?